Provide a flowchart which describes the process for accrual adjusting entries using the balance sheet method and no reversing entries. Recall from our discussion about adjusting entries that there can be groupings. We've already done the prepayment adjusting entries, both deferred expense and deferred revenue, describing them, providing a flowchart, and doing 4 examples. What we're now going to do is tackle the accrual adjusting entries, both the accrued expense and the accrued revenue. Similar to prepayment adjusting entries, accrual adjusting entries have the same characteristics. Because of that, I've again been able to develop a flowchart which tracks standard entries made for accruals. You can then use this process to solve accrual adjusting entry problems. Let me just move my page down. We're going to start with a heading. There's 2 different types of accrual adjusting entries: accrued expense and accrued revenue. At period end, new information is provided about things which are unrecorded and have no cash transaction. Things which have not as yet been reflected in our financial records. For an accrued expense, we find out that the business used, consumed, or incurred a cost to generate revenue. That's the new information that we discover. Because something has been used, consumed, or incurred to help generate revenue, we must record immediately an expense. No cash has changed hands yet, so we've got to record a liability. This is the adjusting entry. Now, time moves forward into the next period. The company pays their supplier. Cash changes hands. Because we're paying off our supplier, the liability no longer exists. In addition, cash leaves our hand. Note that the adjusting entry is occurring at the end of the period. Debit expense, credit liability. It is what's called the subsequent cash transaction, which is occurring in the new period. Accrued expense. Let's look at the accrued revenue. Again, at period end, there's new information about the business's activities that are unrecorded. In this case, the business has provided a service or delivered a good. Notice the past tense, and therefore they've generated income. So what did they get? They have a legal right to claim cash from their customer. That's an asset. Generally, a receivable. What did they give away? They gave away a product or a service, which means they did their job and can claim revenue. This is the adjusting entry at period end. Now, time moves forward into the next period and cash changes hands. This is when the company collects cash from their customers. What did they get? They got cold hard cash. What did they give away? They gave back the customer's IOU because the customer owed us and now has settled their debt, so we are returning the IOU to them. The asset, therefore, disappears. That's the subsequent cash transaction. You can see that accrued expenses and accrued revenue have similar characteristics. Both of them record adjusting entries at the end of the period for information which has not as yet been recorded. So they require an adjusting entry. Then, when we move into the new period, cash changes hands because the company either pays their suppliers or they collect from their customers. Accrual adjusting entries.